Rules-based
Okay.
technical analysis to identify potential entry and exit levels.
Sure. Yeah. And also for any of those people that follow the Nadex profile on or the Nadex page on YouTube, don't only subscribe, but if you guys hit the bell icon whenever we go live in the morning, it will actually send you a notification on your desktop. So if you're there and you forget that we're on, it'll actually notify you. You guys can jump right in there with us live, and then please ask questions, interact with it. We love it in the morning. So with that said, let me start the presentation off today. And I can say before I begin, and again, I probably should have probably added it into the title, the main title. I am getting to speak today about, and again, I have to make my voice deeper for this one, the sexiest trading strategy of all time. And the reason I say that is because whenever you hear trading and you hear someone, and it has to roll off your tongue, right? Fibonacci. Fibonacci, like, there's like magical stars and everything gets blurry, and it's just one of those things that is such a mystical trading strategy that people use. And when I talked to Todd about kind of the audience today and making something that was appropriate for the audience out there, he shared with us a lot of newer people out there. So one of the things that I'm a big believer in is making sure that people have a rule-based strategy to trade with. Okay. There are many strategies that work out there. There are many strategies that don't work for a lot of people, but will work for some. And everybody's different. I mean, every person is different. They have different risk tolerances, different trading kind of tendencies. Fibonacci is one of those things that when people start looking into technical analysis, they inevitably find themselves over here trying to figure out how to become a master of Fibonacci. I know people that do extremely well with Fibonacci. They're convinced that their entire life is a Fibonacci sequence of some sort. And I'll show you how prevalent it actually is. But it's one of those things that, again, with everything, there are pros and cons to every single trading strategy out there. If it was perfect, every single person would be doing it. Nobody would be making money with it because there would be nobody to trade with at the end of the day. So just keep that in mind. Also, before I dive in, just understand I do have about a 45 minute window today to kind of get everything in and then answer some questions afterwards. It is absolutely impossible to teach you guys everything you would possibly need to know about using Fibonacci in that time frame. So I don't claim that this is the Fibonacci master course of everything that you need to know. So again, this is just kind of to whet your appetite, get you guys kind of the basics there, give you kind of the rule set, give you the pros and cons, and then some of my opinions on it. And then hopefully that will get you guys started on creating your own individualized system for you guys to be trading Nadex. So with that said, before I really can dive into a chart or anything like that, I do have to go through a Nadex risk disclaimer. It's pretty easy. You guys have probably heard this before in the past, but trading on Nadex involves risk and may not be appropriate for all. Members risk losing the cost of another transaction, including fees. Now, you should carefully consider whether trading on Nadex is appropriate for you in light of your investment experience and financial resources. Any trading decisions that you make are solely your responsibility at your own risk. Past performance is not necessarily indicative of future results, and none of the material presented herein is to be construed as a solicitation, or recommendation, or offer to buy or sell any financial instrument on Nadex or elsewhere. Now, Nadex is subject to U.S. regulatory oversight by the CFTC, and if you didn't know, Nadex is a registered trademark of the IG Group. So for today, what we're going to do, and I broke this down into kind of 4 different pieces, right? We're going to cover what this golden ratio is. And again, the golden ratio is really kind of where most of the Fibonacci retracement extension strategies come from. Many of you probably have heard the word, but I'll explain kind of where it came from, what it was really used for, and how it kind of pertains to markets. Then we'll go over really the basics of how to draw Fibonacci retracements with a couple different caveats in there. And then why you would use extensions. And then I'm going to kind of leave you off with things to keep in mind. It's very easy to get, I don't know, wowed over. I don't know the correct word for it, but it's very, very easy to, hear about Fibonacci and everything that it does. And just, it's kind of like Star Wars. I'm a big Star Wars fan. And like when you're a kid growing up, like nobody wants to be Chewbacca or Han. They're cool characters, right? But everybody wants to be a Jedi, right? Because of the Force, this mystical power. And that's kind of how Fibonacci is. And again, a lot of people gloss over the limitations to it and just like, no, I'm doing this, that's it. And then when they don't get the results they want, they're kind of like, huh. So again, that's why that things to keep in mind is extremely important as well. And again, you may wonder, why the heck does he have a pine cone up here? Well, believe it or not, this pine cone is actually a great example of what Fibonacci is and the sequencing it is and the relationships of that exist inside of the different ratios. You look at that and say, yeah, it's a cool pattern. It's kind of mesmerizing a little bit. Like if it spins around, like, wow. There's actually, if you take measurements inside of there, where they're placed, how they're placed, how far from the center they are, they are all part of a Fibonacci sequence. It's kind of crazy how it works out. So let's talk about what this golden ratio is that I keep mentioning. All right. So basically, the golden ratio, and I quote that, it's not a gold, it's not like a gold thing. It's just that's what it's called, and it not inside and outside of the trading realm. It just describes like predictable patterns that are everywhere, from atoms, the stars, the solar systems. It's everywhere, and it's called the Fibonacci sequence. Okay, you guys, I'm sure you've heard of Fibonacci. Now, it's named after an Italian founder, Leonardo Fibonacci. That's actually not his name, but it's been shortened to that because everybody knows him. People will say, "Oh yeah, you're that guy Fibonacci." Actually, that's not even his name. That's the funniest part. The Fibonacci name was actually not even created till I think like 1840 or something like that, or like 1839 or 8 or something like that. Yeah, his name is actually, it's funny. His name is actually Leonardo Bonacci, or Leonardo of Pisa, basically a traveler from Pisa. He's an Italian mathematician is really what it boils back down to. The funniest thing is when he created this, he wasn't the original kind of like all the pieces. He kind of took it and adapted it. To start off with, he found that this ratio tended to be in everything, and he actually used this equation. This is the funniest part about this. This is like this magical thing that all the top traders in the world are using, right? It was actually, originally his kind of first proof of concept was predicting the growth of a rabbit population. And you're like, what? What the heck does that have to do with trading? What they found was this is in like everything. Nature uses it. It's a balance. It's in you and I, or it's in a lot of foods. The shell, the Nautilus shell is one of the things they talk about the most. But basically, this is a ratio that the way that it was really kind of formulated was they took a sequence of numbers, and what they did is he kind of invented it by taking the sum of the two preceding numbers. So like 1 and 1 is 2, right? 1 plus 2 is 3, right? 2 plus 3 is 5. 3 plus 5 is 8, and so on and so on and so on. Now, nature uses this all the time. All right, so I put this slide in here next, just so you guys were able to see it. This is kind of my prove it slide, right? And there are so many examples that I could use to kind of go over this with you. And again, what does this help? How does this help your trading? It doesn't help your trading at all. What it does is it just shows you that this relationship is everywhere, and that's why traders use it, because again, at the end of the day, you're trading against other humans. And yeah, I know there's algorithms and things like that, computers, but those were also created by humans. So humans and anything based in nature tends to function and think like this, and a lot of times this may even become a self-fulfilling prophecy. But honeybees, right? I didn't know this actually when I was doing the research into different things that did it. I didn't actually know this, so this was a new learning experience for me. That honeybees, if you divide the female bees by the male bees in any given hive, you'll have that 1.618 ratio. Sunflower seeds, I absolutely knew that the ratio in there of the diameters of the rotations, I absolutely knew that sunflower seeds were another example. Human beings is another one, right? If you measure your shoulder to your fingertips and then divide it by the length of your elbow to your fingertips, again, it comes up with that ratio. If you take your finger to your nose, you can divide that by your overall height, and it comes up to be the 1.618. If you measure your head to your feet and then divide it by the length of your belly button to your feet, it's also the same thing. So what I'm saying is this relationship, it's in the craziest thing. It's all over the place. It's like everywhere. And that's how it kind of got adapted over. Fibonacci would travel around to the different markets and use that kind of to understand how they were doing arithmetic in their systems. So it naturally kind of carried over into the trading realm. Now, really until the advent of computers, it wasn't something that was used a lot. Back in the day, I mean, like when I was younger, when I say back in the day, before computers were in everybody's single household and we could chart at home, this was kind of one of those tools that only professionals had because they had the big trading computers. They were on the floor. They could see it. It used to be that everybody, to have charts, had to plot things by themselves. So as, technical analysis has become more of a home tool. Fibonacci has gotten more and more and more and more popular inside of trading, okay? Now, when we're talking about trading in particular, what we're talking about is the Fibonacci sequence. It's not about a whole bunch of different ratios, but the sequence that we'll be talking about, right, as far as trading goes, is typically shown in percentages, right? And you'll hear this again and again, and I'll show you guys how to do the draws and things like that. But the three most common percentages that traders in general care about are your 38.2%, your 50%, and your 61.8% kind of levels. All right. And again, they're all different levels derived in here. It's kind of, you look at this Nautilus shell and you can see that they're, ever increasing, getting bigger and bigger and bigger, and the diameter gets bigger and bigger and bigger. And how thick is each of the rows? These all come into play, and they're all, these percentages are the things that we see again and again and again. Now, these are not the only ones. Okay. Another very common one you'll see is the 23.6 percentage is good. You may notice this 161.8. Remember the ratio in the last slide, the 1.618. Yeah, they're all multiples of the same thing, and it repeats again and again and again and again. So that's what's considered the kind of the sequence that we're using, right? But like I said, just so everybody understands, this is not something that like Warren Buffett decided that he's going to let this secret strategy go. This is something that's been around for a very, very long time. Okay. Now, there are big proponents of this. There are people that are detractors from Fibonacci. It's one of those things that you almost have to be a master of it. But the thing is, people make it so much more complicated than it actually needs to be. Now, if you do not have a trading system, right, or your system is like a moving average system, right, one of those things that is extremely lagging, Fibonacci sequences and retracements and extension will kind of help you take yourself to the next level, because it adds a whole lot of rules in, and it's a very, very easy strategy to add in. Now, even if you're an experienced trader and you think you got it all figured out, you will be absolutely surprised when you start drawing some Fibonacci retracements on your charts, how many times you will find trading signals that overlap with other strategies as well. Okay. Now I'll talk about that in a few. Just, again, I want to kind of roll through this, make sure we go through, but just understand these sequences happen everywhere. If you do a Google search on it, you will be absolutely shocked about our fingers to our toes, to our belly buttons, to our eyebrows, to our ears, to our chin. It's unbelievable. Things like pineapples and clams and obviously nautiluses and pine cones. It is everywhere. So it's thing, right? It's not made up. Again, have confidence in that. So let's talk about retracements, because primarily when someone is talking about Fibonacci, they are talking about retracements in regards to, where it pertains to obviously charts, right? And trading, making money, things like that. So a Fibonacci retracement is basically drawn by taking two extreme points of a stock chart and dividing the vertical distance by the Fibonacci ratios. Again, 23.6, 38.2, 50, 61.8, and then the 100. Okay. Now, Fibonacci retracements suffer from the same drawbacks as all universal trading tools. Okay. So this is one of the biggest downfalls. If you guys learn nothing else today besides this is what I want you to take from this, right? This is a tool best used in conjunction with other indicators. Okay. This is one of those things, and again, whenever you talk to anybody that really understands and knows what they're doing about Fibonacci, they understand the limitations of this and the need for some type of a confirmation type based system. Okay. Some people are like, no, that's all I need. I'm just going to take a billion trades and I'm going to do it here, 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 and here. The big question is, again, one, how you draw it, but two, what level do you take? Because I just told you there's a 23.6, a 38.2, a 50, a 61.8. There's a lot, right? There's a lot. Now, here's what it looks like. Okay. When you're drawing it, now I did two things here. The one on the left is actually coming out of the Nadex platform. So if you're new to trading and you don't have outside charting platforms, if you're going to draw it, you absolutely 100% can draw this inside of the Nadex platform. So if you're on your live account or your demo account, or maybe you've signed up for information, but you don't even have a demo, if you need a place to be able to draw these, you can absolutely open up a demo account and you can start drawing these. Okay. Now, as I mentioned before in the previous slide, they are drawn from extreme ranges of high and low. Okay. Now, this is where it gets a little bit complicated, and this is where people get lost right off the bat. Okay. Oh, by the way, before I get this question, the one on the left is done inside of the Nadex platform. You have the ability on a limited basis to kind of put what percentages and what price levels and everything you want up in there. The one on the right-hand side actually comes out of TradingView. And you can see it shows you the same information. It just shows it in different ways. That one tends to be a little bit more colorful, but obviously that one doesn't show the prices on there. So there's no right or wrong reason there. It doesn't matter. It's going to draw it, and the percentages are going to be in the exact same spot regardless of the platform you're on. Now, how you draw it does matter. And again, experts, it's one of those things. Experts have many ways to draw this. Okay. If you take it from just the basic kind of, this is what it is, it's extreme to extreme. So inside of an uptrend, you're going to draw it from low to high inside of a move, right? Some people will argue because price touched the wicks, you need to go wick to wick. Okay. Some people will say, no, I don't care about the wicks. I only care about the bodies, and they will go body to body. Okay. You may say, does that make a difference? And the answer is, yeah, it may. You get into some trades you don't need to, and others you may miss. Because remember, when you draw it, the lines will be in a kind of different situation. Again, this is one of those reasons why you need to kind of have it be with something else out there. If any of you have watched me, I apply this with supply and demand. Okay, that's not the only way you can do it. But again, there are some ratios that work really, really good. And when the two systems match up, it's amazing how many times the trades work out. On the flip side of things, okay, when you're in a downtrend, you're drawing it the opposite way. You're going from high down to low. And again, you need to figure out for your personality what you like. If you like body to body, some people like wick to wick. Some people even like pullback or like inside of, they're not taking the extreme, maybe taking the high of the first push to the high of the next push, or sometimes the low of the last push to the low of the next push. So there are many rules out there to draw it, and everybody kind of has their secret sauce on there. But if you're new to using Fibonacci, I would say use the extremes. Those are the most basic forms of it. And I actually, for me personally, I don't use Fibonacci on every single trade, but I will typically draw it. And most times I've been looking at charts long enough, I can look at a chart and tell you where the percentages are with a high degree of certainty. But that's because I've spent years doing this, and I can look at it. I don't necessarily need to draw it. For me personally, I use Fibonacci as a confirmation for my main strategy that I use. A lot of people use Fibonacci as their main strategy, and then they look for a confirmation later. Either one is fine. Whatever you guys want to do works out perfectly, okay? If you want to see how they're paired together the way that I do it, again, attend those sessions in the morning with Todd. A lot of times we'll draw them on there, and that's where I kind of mainly go over supply and demand and how I use it. So just keep that in mind. If you're going in an uptrend, you're going from low to high, right? In a downtrend, you're going from high to low. I typically just draw it from the extreme to extreme. There'll be cases where sometimes I use the wick depending on what we're here, the body of the candle versus the wick. And again, just be consistent. And again, I would say play around with it. I hate when people are like, no, this is the only way to do it. This is the right way, really, because there's other people out there that have done it differently and it's worked for them. So again, it's hard to be, it's hard to say that it's concrete that there's only one way to do it. Okay. Now, with that said, here's what it looks like inside of Nadex. The way you find this is up on the top menu. You'll see that little, kind of this little piece up here. I don't know if you guys can see that or not, but that little, the little pencil, right next to the eye and then the chart symbol. You click on that, you have this drop down of the different drawing tools, and you just click Fibonacci retracing. And then wherever you click your button, you're going to be able to drag it. In this case, it was an uptrend, so we went from low up to high, okay? Now, this is where I kind of go back and forth with using the extremes, because in this situation, the low of this candle, where it touched that, that kind of 100% at the bottom, right? And again, this one, technically the numbers are backwards, but they're percentages, so the percentages are in the exact same spots. If the low never had a wick on there, you're using the body of the candle, right? But if it went much lower than that, then wouldn't that have shown you that there are buyers and sellers below where that body of the candle is? So it's kind of hard because sometimes you use the body, sometimes you're not using the body. It's the consistency of it that kind of gets a little bit strange, right? But in this case, you can see that we had to move all the way back up again. Price came down, and then obviously, it ended up hitting that 50%. Had your 50 been your actual trigger in this case, guess what? You probably would not have gotten in. Now, this is where Nadex kind of comes in nice, because if you look at it, they're actually, and if you look to the right, if you're wondering what those are, there's all those red and green kind of boxes on the right-hand side. Those are Nadex binaries. You see how it's actually not dead on the line, it's just a little bit above, just happened to turn right on the Nadex binary. So one of the nice things about, in particular, binaries in this one, which is a little bit different. Again, remember, in futures and anything spot, anything in the cash-settled markets, you got to be dead on. If you tell it buy it at $90, it won't buy until it's 90. Where Nadex, because it's kind of a little bit get it close type scenario, right? Nadex actually helps you do a better job at getting into positions, because you would have most likely gotten in if you'd been trading a binary off of this one. And you can see, I mean, this is a 30-minute chart. Within 1 hour, went from the 50 all the way back up to the 23.6. Very, very fast, And again, you can see that these are shorter duration binary contracts. So, again, it jumped over a number of them. All right. But it's really as simple as that. Now, again, this is just using one strategy. Remember, I just told you, and please don't forget this. You always need to have that confirmation in there of some type of some type of thing. For me, this would have had the confirmation. It would have been entered, and again, Fibonacci would have kind of confirmed it for me in the upward direction. Now, you may say, all right. I'm kind of getting it. I like the 23.6, the 50. I'm not going to remember all these. How do you do it? Typically, these are the standard ratios. If you want to change any of these or maybe add some or remove some of them out, there are other things you could put in there. You can use it off percentages. Basically, just double click on the indicator inside of the Nadex platform, and you can check these boxes, the ones that you want or the ones that you don't want. For me, obviously, the 1 and the 100 always are they have to be in there. But I try not to make this too complicated. There are people that make it way more complicated than I do. But again, the company's called Keep Trading Simple. I try not to overcomplicate things. I just personally stick with the 23.6, the 50, and the 61.8. Again, if you guys have never used this, just use those 3 ratios. Again, keep it simple. Those are the most common and most popular ones. And again, that's what you need to look at, right? Now, here is another example, right? This is in the opposite direction. You can see it pulled down. What did price do? Again, this one went from kind of the extreme high to the low. It ended up grabbing that 50% retracement. Now, I'm going to get this question, and we may already have it up there, and hopefully I can answer this one. And you can kind of remove, just we don't have to go over it again. I'm going to get the question, how do I know if it's going to turn on the 23.6? Or how do I know if 50 is going to be the one that holds? Or how do I know that 61.8? Like, what do I do with these different ratios? Absolutely amazing question. I'm glad that you asked it. If you didn't, you were thinking about it, you would have asked it in a little bit, okay? The reason why I say this, it's important is because this is the part that a lot of people don't ever tell you about. They're like, well, you could just take 1 million trades. You could take it at the 23 and then take it here and then take it there. Like, no. Have an actual plan going into this, okay? I know traders that 50% is their favorite. They only trade 50% retracements. Does that mean that they miss trades? Yes, absolutely. They miss a lot of trades, right? Because it will bounce off that 23.6. Do I know people that trade the 23.6? Absolutely. Do they get stopped out more than the guy that only takes the 50s? Absolutely 100%. Why? Because they're getting into more trade entries. More trade entries, again, things are going to go up and they're going to grab that 50%, right? And that would be beyond kind of what an acceptable level of risk is. So again, that's kind of one of those things that you need to play with. Now, another question I'm going to get right now is you're looking at this and you're saying, okay, I'm starting to get it. I get the percentages, right? 50%, that seems like a decent one. I'm kind of a conservative guy. I like that one. I know that I need to be close. You just mentioned that with binaries. What kind of chart? What do I look at? What time frames? And that's an excellent question as well, okay? One of the things about Fibonacci is it can be used on longer term kind of swing trades, right? You could use it on shorter, intermediate kind of intraday trades. You can even drop down and use it on like the 30-minute and the 5-minute. Why? Because there's pullbacks. The way that the market moves, you guys can see, I mean, every time there's a red, green, and then pullback again, and then these are all different areas that you could measure on different time frames, and 9 times out of 10, most of them line up to some type of a retracement. Now, that's also where it gets a little bit complicated. What I mean by that? Well, you may draw it on the 4-hour and it shows you one thing, and you may draw it on the hourly and it's different, and then on a 30-minute, you got another different signal in there, and then there's a 5-minute, you drew it there, and you're like, oh my God, I got another signal over here. How do you know which one is right? The question is that comes from chart time and experience. Okay, when you figure out what time you have allotted to trade, that's typically the time frames that you want to be, best associated with. It is a trend following strategy, so you have to have a way to determine what the trend is. Can you really determine what the trend is on a 1-minute chart? I guess, but not really reliably. Can I get a 4-hour trend? Sure, but is that really going to help me to figure out what's going to happen in the next 30 minutes to an hour? Probably not, right? So it's one of those things you do need to use multiple time frame analysis to be able to do this, okay? Now, here is my warning slide. And again, I try to warn you guys as much as I can. Like I said, everybody gets so drawn towards Fibonacci, and it is an absolutely amazing strategy. But unfortunately, it's kind of like there's like 8 steps to use it. And again, I'm just making this number up right now. If there's 8 steps to use it correctly, a lot of people only focus on the 3. Okay. Now the use of the Fibonacci retracement is subjective, right? Subjective in what time frame do I use? Am I using the extreme wick to wick? Am I using body to body? Am I using it only during market hours? Am I doing it in European session? Am I doing just this one? Am I doing full days? Right? Traders use this, and again, all traders use technical indicators in different ways. Even if I tell you exactly what to do, you're probably going to go home and add some secret sauce to it anyway. Being an educator, I've kind of gotten accustomed to that I give somebody something and they always tweak it in some way to try to make it better. And Again, everybody uses these things different, but those traders that make profits using Fibonacci swear to it that it's the only way to go. But at the same time, the people that try to use it and lose money, then again, they tend to say that it's unreliable. Others, and again, I said this earlier, that many people argue the technical analysis is a case of a self-fulfilling prophecy. I'll tell you right now, Fibonacci is one of those things that I wholeheartedly believe that it does become a self-fulfilling prophecy. You know why? Because so many people know about it and so many people have confidence that this system is so magical. And remember, at the end of the day, for you to buy something, somebody needs to be selling something at the same time. When you know that all the population out there, or majority of the population, all wants to do one thing, can you create the scenario to give it to them and take advantage of it? Answer is yes, right? Big money can absolutely say, hey, there's a 23.6 Fibonacci retracement coming up. I know that people are going to be looking at this one. I know that people are just going to say, hey, look, it's a 23.6. We have to get in just because of, this mystical number. So again, understand that a lot of times these things will turn and roll because they are a self-fulfilling prophecy too. So I'm the believer here that, like I said, I think Fibonacci is a great tool. I think Fibonacci, you should definitely know where it is, not only for your own trading. And again, I like to use it as a confirmation, but I know plenty of people that use it as their main strategy and they confirm with other things. And if it is a self-fulfilling prophecy, at the end of the day, if I'm expecting to turn and it turns, do I care? Why? No, right? I don't, right? Every single trade has risk involved in it. You got to make sure you're willing to accept that. So again, that's the things about Fibonacci. It's very, very much like Elliott Wave. If you guys have ever heard about Elliott Wave, right? The big supporter of Elliott Wave will say, it's always right. If it didn't work, it's because you drew it wrong. It's trading. There's no absolute certainties, and there's no way you're going to be able to sway me differently, right? There's always something strange or crazy that can happen suddenly in the market, and no indicator can prepare for that. And to say that something is right 100% of the time, and if it didn't work, it's because you drew it wrong, that's an excuse. Fibonacci is kind of like that as well. But like I said, most of the Fibonacci traders I know that are really kind of experts on it. They'll agree. Again, you have to manage your risk on every single trade. There's no guarantees in trading. And again, will you take losses? Sure, but it's the way that you manage your losses. That's what really matters the most. And again, Fibonacci actually does do a good job of helping you do that. And that's where kind of the second piece of this comes in, the Fibonacci extensions. Now, I would say this. Extensions are absolutely not as popular as retracements, okay? Everybody does retracements. Not many people talk about extensions, and it's one of those things, depending on your money management strategy, you may or may not even want to use the extensions. I know how to use the extensions, but I tend not to. I tend to rely on risk to reward a little bit more than kind of relying on these percentages. I'm a big believer that the only time I have any risk on is when I have a position in, right? If I don't have money in the market, I'm not at risk, right? So when I do have money in, I want to make sure that I'm controlling my risk as best as I can. Are there times when price moves way beyond what my profit target is? Absolutely. Absolutely. But at the end of the day, are there times where people get greedy and then it goes all the way back against them and they lose money on the trade they were profitable for? Yeah. Yeah, it happens. So let's talk about extensions now, right? All right, so extensions are a little bit different, right? They're to complement, and again, this is a complement. So if you have a hard time trying to figure out when you're getting out of your positions and you're like, hey, I'll just throw Fibonacci retracements in there, or I'm sorry, extensions in there. It's meant as a complement. You got to kind of do step one before step two. So I'll just say that, right? But extensions are complement, basically to figure out how do you find targets based off of the same kind of, ratio method. Right? It's kind of like I'm drinking the Kool-Aid, but now I want ice in the Kool-Aid, right? It's how do you keep going along those lines? And again, I know people that do great things with the extensions. Sometimes they'll be like, hey, check this out. Look at this. It banked right off the, the 61. I was like, all right, that's pretty impressive. For me, I would not have picked that as a target. It's great that worked. And again, I'm not right all the time. There are definitely better traders than me out there. I think there's always better traders out there than, there's always going to be somebody better than you, right? And I'm fully on board with that. And sometimes these guys sometimes even amaze me, right? Just turns for no reason. But there are times where things turn, I'm like, yeah, that'll never go there. And again, it works in both directions. And it is what it is. But basically what this is doing is this is predicting targets past that 100. Remember, when we draw the retracement, we get the 0 and the 100, right? This is to help project things beyond past that, which again it can provide potential exits. Why is that important? Well, with Nadex, we typically have an expiration value. We need to know where things could potentially go to. Remember, a binary contract at the end, you either get paid 0 or 100. If you have a target that is not as far as where the the binary is that a smart trade? Probably not, right? Could it go there? Sure, it could. But again, if you're expecting price to go to a specific level and that's not far enough for the binary, it's probably not a smart trade, right? So again, it's about potential exits. And again, the same warning, the extensions suffer the same drawbacks as any other tools. They have to be used in conjunction with other things. Now, when I say it has to be used in conjunction with other tools or other indicators, I don't mean just the retracement. Because remember, the retracement for the entry needs to either be confirmed or be the confirmer to make it a good, valid strategy, right? And then you can add the extension on top of it. And here, this is what it looks like, just so you guys get a better picture of it, right? So it's a two-step process versus a one. Remember, when we draw the retracement, we're going from either high to low or low to high. In this case, it went from low to high, right? And then we stop up in the dot, kind of right at the middle at 50%. But then you can see that there is another dot where it's been pulled down to the right. What that is that's the draw for the extension. And what it does is it shows you, based off those same ratios that we've been talking about, where the potential profit targets are. Right, so we pull back. If it pulls back up to the 23.6, you can see that it goes up to 23.35. The 50% retracement would be, or the 50% extension from that pullback would be a 50.43. The 100 would bring price all the way up to 23.57. And if it went all the way up to, again, that magical 161.8, price would need to go back from an entry at 23.28 all the way up to 23.74. Okay, that would be up at that magical 1.618. Right. But again, I would say the most popular extensions that people use typically are the 50% and the 100. I would say those are the most common. Some people have heard me talk about measured moves in the past. It kind of coincides with the measured move here as well. I'm just doing it a little bit different. When I say measured move, I tend to kind of use the same method for retracement and picking profit targets. This is just a lot more precise. So if you're a numbers type of person, if you see me do measured moves, it's very, very similar. But now, by using this, what it does is it gives you a rule-based exit strategy, okay? I get asked all the time, how do I know when to get out of a position? Okay, and there's a lot of different ways that I can answer that as an educator. There's a lot, okay? If you don't have a rule on how to do this, this could be a great addition into the way that you do your trading. Okay, now what does it look like on a chart? Let me show you. Go up here, click this button, and it should pop up. There we go. Okay, you find it the exact same way, right? Exact same way. Go up to that little drawing line, go down, instead of hitting retracement this time, hit the extension button. Okay, as you can see in this example, we went from the high down to the low, that kind of like low pivot, right? Down to the 21.87, and then I knew that I had a Fibonacci entry level right up there around that 22.8. So what it is, I drew the extension back up again. Now I drew the pink and the green box was something I drew on there, so you guys can see that one. We knew we had entry. It's the same. This is the same chart as what we did with the retracement, but then I just drew the extension off of it. And as you can see, right, in this case, it's pretty interesting that it hit that level, it came down, and it had some problems, right? It started to base around that 23.6. You can see they went past it, and then it kind of pulled up again, right? It kind of pulled up to here, and then kind of pushed down, and then pulled up again, right? It just shows you like, wait, why did it do that? Well, it's a 23.6. Now it blew through the 38.2, right, and came all the way down and blew through the 50, and then all of a sudden hit the 61.8, and all of a sudden, what did it do? It started to kind of base around a little bit, and it punched, then came back up and started to base around the 68, right? And then dropped all the way down, and what did it do? It ended up going down and hitting 21.65, the 100% level. And then what did it do? It pulled back up again, hit the 76.4, and then came right back down and hit the 100 again. So when you look at this, it's very easy to see how people get mesmerized by this, right? You're like, look at that. We had a retracement. It hit at 50%. I just drew this on here to pick my profit targets, and it had issues at 3 of those levels. It took 2 bounces off the 100. And then what did it do? It rallied all the way back up to the 38%. Right? And again, if you look at where it bounced, it came up and hit on the way down, it pulled back up and hit that 50% level, and then hit the 100, and then hit the 100 again, then hit the 50, then pulled down, then hit the 38.2, came back down and grabbed the 61.8 again, then came all the way back up to the 32.6. And then where is it right now? Price is sitting right above the 50. So isn't it amazing when you look at this and say, this is unbelievable? If you did not have this tool on here, I would say this is just the natural ebb and flow of the market, right? It's pushing up and it's pushing back. And, this is natural, right? Impulse correction. But just in one simple move, right? And again, guys, this was from the other day, right? This was from the 27th, actually the 28th of July, right? On that Wednesday that I drew this one. So this is not like this is just, I needed to turn the deck in, get it approved. And I pulled it that morning. And this is a 10-minute chart, right? You could literally go, right now and go do these same type of draws. This is the type of this mystique is what drives people towards Fibonacci. And again, there's so much opportunity out there when you're understanding the things, right? And it's just amazing. I mean, just in this one example, you hit what? 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11, 12, 13 touches of those levels just on the way down, right? 13 different ways that you could look at this and manipulate this one. And again, the more chart time, the more experience you get, you can learn how to really kind of play a lot of different things off of it. So it's really remarkable how powerful these things can be. So let me go into the things to remember, because again, at this point, I'm not trying to sell you on the mystical powers of Fibonacci, but it's one of those things. It's a trading tool that many people use that can be added even at the most basic beginner level. Like I said, if you remember, what percentage did I say you should be looking for? If you are an absolute beginner, you've never drawn Fibonacci at all, and you want to get out there and try to start doing this to give yourself a rule-based strategy, because again, you got to have a rule-based strategy if you ever expect to make any money, use the 50%, right? The 50% is the easy one. It's a very common one. It's typically a stronger pullback level. Are you going to miss some opportunities? Yeah, absolutely, but that's okay, right? You don't have to get every single trading opportunity. You don't have to turn an account, right? Go for the highest quality you can get, right? So here are the things that remember. These are the factors you need to consider before placing in trades. First one is that Fibonacci retracements are part of a trend trading strategy. Okay. Now, everyone's heard this saying before: the trend is your friend until the bend at the end, right? So just understand that for you to use a Fibonacci retracement strategy, you have to be in a trending market. Okay. Question is, do you know what a trending market is, and are you in a trending market? If you're not in a trending market, could you use Fibonacci retracements? Not really. Okay. Last couple of days, we've kind of been in that scenario where, like gold this week, right? Gold got hammered. It was blown up to the downside and then pulled back up again. And then what did it do? It basically just flatlined on it. So it just went sideways for like 12 hours. It did nothing. It was not trending anymore. So it's hard to use Fibonacci retracements when we're in a market that's not trending. So, is it truly something that you're going to trade at 7 p.m. at night, right? Are you going to trade stock indices 7 p.m. at night when the markets are not moving? Not really, right? So, yeah, there may be a market open. There are Nadex contracts, but is it the best possible time for you to use it to trade? No, not really, right? You need markets that are moving, right? You need some trends, some power behind that. And there's different indicators to figure out if the market is trending or not, right? Number 2. Fibonacci extensions attempt to predict the future price targets. Now, Fibonacci extensions, they establish target prices, and then again, it's kind of following a breakout, right? Remember, it's pulling back a decent amount, showing that it's kind of broken high. So it's one of those things. Having it continue lower, it's like, listen, it's putting, it's kind of reversing trends. It's pulling back. It's kind of turns. It's pivoted. So it's kind of trying to predict the opposite of what we've seen recently. Right, because you're trying to have it pull up higher, and again, you expect it to continue, but how do you know it's going to continue to go lower, right? Versus, the question I get is, well, how do I know a new trend hasn't established itself? And that's a great question, right? And again, that goes back more towards the risk management side of things. So again, if I had to say which one I like better, I like the retracements better than the extensions. But for people that have a hard time exiting trades, that get greedy sometimes, the extensions is an extremely valuable tool that can be added to your trading that will help you not kind of get your trades eaten up, right? When you've been, profitable. Now, number 3, and this is a biggie, like a real biggie, complexity. Okay. At this point, if your head's not spinning even a little bit, I've tried to keep this rather, kind of tame. The complexity, this is very difficult, right? How do I draw it on a 30-minute, a 5-minute, a 15, a 10, an hourly, a 2-hour, a 4-hour, a daily, a weekly, a monthly? What am I drawing it on? again, it depends on your individual trading styles, right? Then you also got to say, well, listen, if I'm going to do an extension here, a retracement over here, I drew it on the 30-minute, then I went down to the 5, and next thing you know, you can't even see the chart anymore because you got so many different lines of percentages all over the place. This is a very common pitfall with using Fibonacci, right? As well as, are you going to use the extremes? Right? You use the wicks. Are you going to use just the bodies? Sometimes there's no wick and you got to use a body. Then is it consistent? Are you going to use the extreme? Or are you going to use the first pullback? Or are you going to look just for big candles? So there's a lot of moving pieces in there and the complexity as well. And again, I would say keep it simple, right? Use that 50%, use the tops and bottoms, and again, then kind of tweak it as you get more experience and familiar with drawing it. Go from there, right? That's how to kind of overcome the complexity of things. Now, it does not. Here's another thing. It does not provide easily identifiable strong and weak signals. Okay, by itself, right? By itself, Fibonacci does not have kind of a side piece that says, here you go, the 23.6 is a strong level, or the 50 is a strong level, or the 61.8 is a strong level. It doesn't have a ranking system, and that also is the reason why you need to be using it with something else. And it's also one of the reasons that people will fail with Fibonacci because they use only Fibonacci in their trading. Okay, and again, maybe you're super aggressive and you're going to take every level that hits, you're going to take it, right? You saw that last chart, you're like, oh my God, there's so many entries, long, short, and that's how you want to do your trading. It absolutely can lead to over trading if you're not being very selective with what you do. Okay. Last but not least, Fibonacci tools it's basically, Fibonacci, as I mentioned, it's a numerical anomaly and it's not grounded in any logical proof. The fact that a specific percentage is going to be the turning point, right? And again, the fact that it's like, well, your finger and your toes, it's not like, like when we were made, there's a handbook, like our internal, like, the Mommy Factory, right? It's not like there's a schematic that it says, okay, well, this is going to be this, and this has to be this, and this has to be this. That's why all kids and people look different, but those percentages are always about the same because, again, that's kind of how, nature is, evolved. If you're one of those people, like if you're an engineer or like a pilot or somebody that really needs absolute certainty in your trading, Fibonacci, or there may be, it's going to be, you're going to have a love-hate relationship with it. If you have success with it, you're going to swear by it. Everything in your life will be Fibonacci based from now going forward. Like the amount of rice on your plate to the amount of steak you eat, it will be Fibonacci after if it works for you, right? If you have a hard time and you're not having the success that you want with it, you will have a very difficult time grasping why anybody in the right mind would use it because, again, it is not based in fact. Right? It's not, it's kind of one of those things. It's why is it turning here? Well, because it's a ratio, right? Right? It's truly an anomaly. It's such a hard word to say, right? It's like an enemy, but anomaly. So again, if trading psychology is one of those things that has become an obstacle for you, Fibonacci is it's a love-hate relationship. So just be cautious with that one as well. Okay. And again, because this is for Nadex, and again, many of you are new and maybe not even placed your first trade out there, the 3 products you can use with Nadex are binary options, knockouts, and call spreads. Okay, you can absolutely use these for all things. Remember, they're there to give you a set of guidelines. For your binary options things, if you're going to use Fibonacci with binary options, the things that I would watch out for, again, think about those expirations. Figure out, can price move to where that profit target is in the time that I have allotted till expiration. Kind of add another step on you. Because here's the thing. Could it move down to the Fibonacci target? But if it does it after your target, if it hits the level or goes beyond the strike after it's already expired, does it do you any good? The answer is no. Okay. You can absolutely use it for binaries. It's great for binaries because you can kind of get into that frame that, like, I'm close, right? Like, as kids, you're like, oh, close doesn't count. And then somebody goes, except with grenades, right? It's that's kind of binaries. As long as you get it close and the profit potential makes sense for you, excellent opportunities in binaries. Just make sure the market's moving, make sure you have enough time to get to your profit target before the expiration time frame. Now, knockouts. Knockouts work really, really well too, because again, sometimes Fibonacci can take multiple days to unfold to reach its true potential. Because remember, right? Some of those examples, the price went all the way down, and then it pulled about halfway back up again, and then it continued lower. But not only did it go below its low, which tends to be the target for most people, right? It went all the way to that 100%. That can take some time to unfold, okay? Knockouts have an advantage because you kind of have that longer duration if you're going to find something at the beginning of the week, right? Again, The longer duration, the no contracts closing tends to be good. Plus, you can take the knockouts out anytime that you want. So again, do you need to hold it till expiration? Nah. I mean, if it moves really, really quick and it gets your, remember when you do an extension, right? When you pull back to that 50%, right? The recent low where the original pullback was drawn to, that 100% mark, that tends to be the profit target for a lot of people. Okay, so that's a decent area. Just take it off, right? Knockouts give you a good ability to do that. Now, call spreads, kind of a combination of both. Can you take them off at any time you want? Yeah, absolutely, right? Is there longer duration? Yeah, there's some in there, right? Do you have to worry about price moving past a specific point to get paid for it? Not really, right? Wherever it stops, bam, you get paid that much money based off of the floor or the ceiling. So it also provides good opportunity. So it's hard to say that one of these is going to be better than the other. All three of them are very distinct, different types of way to enter and use them. You can absolutely use Fibonacci with all three of these. And like I said, it really depends on what your trading time is, your opportunity to go from there. And again, I'm going to leave you guys with this. I like the extensions. I think the extensions are good if you don't have a plan. I mentioned that I'd like to focus. And again, this is kind of a little bit of homework for you guys. When you get out there and start drawing, and you should absolutely start drawing these things, right? What I would say is go out there. And again, I like to use risk to reward ratios. Okay. Here's a little kind of added thing for anybody that made it to the end. A lot of time, and I told you guys to use a 50% retracement. If you're using the 50% retracement, if you're using Fibonacci as your main entry strategy, right? Not the confirmation. Remember, I use it more for confirmation. If you're using it for your main strategy and you're confirming it with something else, a very common thing that people do is they enter on the 50 and they use the 61.8 as their stop loss. Okay. For me, I use it as a confirmation. I want to make sure, for example, I would want to make sure that the 50 is in my buying or selling area. I already have my risk established, and a lot of times it's smaller, right? But at the end of the day, what you want to do is you want to pick a system. If you're going to use the 50 and 61.8 versus, what I kind of do with my supply and demand, make sure you do it consistently. Do it again and again and again and again, right? 30 times before you can make a change to it is what you said, is what the amount is that you need to have something be statistically good or bad for you, right? Don't take like 3 trades and be like, nope, this doesn't work, right? Because that's the wrong way to look at it. You need to make sure you have a track record, looking at it again and again and again and again. And 30 is typically the minimum amount you need in a subset to have a significant result, okay? So, I'm not telling you how to place these. You can go place them in demo, do your analysis, check it out, place as many demo trades as you want, but you can absolutely use it with all three. What I find is most traders specialize in one of these, and then they kind of, remember I said you guys will tweak it. Whatever I give you, you're going to tweak. Figure out which one of these you like, whether it's binaries, knockouts, or call spreads. And then again, use this to kind of tweak for your, tweak the Fibonacci retracement strategy in the entries to your individual, personality, okay? Because at the end of the day, every single trader is different. Oops. There we go. And with that said, that's the end of my time today. I went a couple minutes late. If you have any questions for me, you guys are more than welcome to, email me at support@keeptradingsimple.com. You can check out the website. I would say too, jump in our morning sessions with Todd and I. We'll go on 8:45 to 9 o'clock every morning. We'll make sure that we give you something, and then you have plenty of time to get ready for the U.S. market open. And again, we bring up Fibonacci every so often. It's always fun to draw it. Be like, wow, did you see that? Look at this. It turned right off of this one, came right across, bounced off the 23.6. But there's no replacement for putting the time in front of the chart. That's really what matters most.